And there were some good comments about investing in US equities from the portfolio managers just now. So I'm glad to be able to take the discussion a little bit more in depth. Well, let me introduce Harris Associates. So Harris Associates is a value equity manager based in Chicago in America. And we actually have roots dating back to the 1940s. So in 1948, there was someone named Irving Harris. He was an American entrepreneur, and he actually had an at-home perming product. So he sold this product to Gillette for about $48 million, and he needed a process and philosophy to manage that nest egg. And what he chose was a value investment philosophy. So shortly after, he collected money from his family and friends. He hired other talented individuals. And from there, Harris Associates was formally founded in 1976. And so all the way back then until now, we really honor those value investing roots. It's the same philosophy that we employ today. We manage approximately $100 billion in AUM. About half of that is in dedicated US equity strategies and funds. So going back all the way to our history, we've been investing in US equities from the very beginning. We added on global and non-US capabilities in the 90s. But again, going back, we've always really focused on investing in US equities. Also like to mention that Harris Associates is owned by Natixis Investment Managers. So you might have met some of my colleagues earlier today. Natixis is actually a $1.3 trillion asset manager. And Natixis owns about 20 boutique investment houses, and we have offices all over the world, including here in Singapore. Now, drilling in a little bit more on the U.S. equity market as represented by the S&P 500, the S&P 500 being the top 500 stocks in the U.S. equity market by market cap. Now, the U.S. equity market has given very good returns over the past many years. This chart goes back to 1973. That being said, there has been volatility, there have been drawdowns. So that has led some people to think, well, what if you can time the market? What if you can miss some of the drawdowns and participate in some of the upside? So what would have happened if you did a strategy where you, say, sold all the new highs and waited to reinvest when the market looked cheaper? So if you had $10,000 back in 1973 and you invested it in the S&P 500 index, today, you would have about $2.3 million. On the other hand, if you took that same $10,000 and you sold the index at every new all-time high, you waited for the index to drop 10% before you reinvested, you'd have about $117,000. And then what if you waited for the market to decline about 20%? You would have $100,000. So you would have about 10 to 12 times your money. Not bad. But again, that's compared to 230 times your money if you just stay invested. So just really want to emphasize that point because it can be tempting to try to move in and out of the market. But historically, it's been very, very difficult to do. Now, is the market too expensive? I mean, there's been a lot said this year about the market reaching new all-time highs. In fact, the S&P 500 this year, the first 6 months of the year, actually reached new all-time highs about 31 times. So it is important to have some context here, though. If you look on this chart, every green line represents a month where the U.S. equity market reached a new all-time high. So going back to 1974, the U.S. equity market reached a new all-time high in about 26% of those months. So the point I want to emphasize here is that the market reaching new all-time highs is actually not all that unusual. But why has the equity market done so well? So again, there's been some comments on that earlier. It is a very resilient market. You can see that in terms of GDP growth this year and next year, we're still expected to outgrow many of the economies in Europe as well as Japan, i.e. the different developed markets. It is a very robust economy, a diversified economy, an innovative economy. So to a large extent, a lot of the strong U.S. equity returns have been justified. That being said, what exactly is driving the market? It's interesting. When you look at the S&P 500 returns last year and this year, the returns have really been driven by a pretty narrow set of stocks. So if you look at last year, 26.3% return, about 66% of those overall returns were driven by 8 stocks. Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, Alphabet, Broadcom. So these are all stocks that you probably know. They're quite well-known companies. And then this year, about 70% of returns were driven by about 8 stocks. And it's pretty staggering. Nvidia has driven about 30% of the market's returns this year. And it's valued at about $3 trillion, which essentially is bigger than some stock markets in some countries in Europe. So it's not to say that these aren't good companies, but we just want to understand that it's been a very narrowly driven market. It's really been a narrow set of stocks, which is why the market has done as well as it is. And so what about the other stocks? I mean, there are 492 other stocks in the US equity market. Are those worth investing in? And so that's sort of what I want to focus here today, is that we think out of the other stocks, other than these 8, we think there are a lot of interesting opportunities. So stocks that aren't weighted as highly in the index, they are in industries other than technology, and we think they look a lot cheaper. So what exactly is value investing? So you can think of value investing as like investing at a discount, right? Like when you want to buy something, you want to buy something on sale, say you want to buy like a TV or a hairdryer or something like that. Maybe you don't buy it right away. You wait for it to go on sale on Lazada or Shopee or 7/7 sale, 8/8 sale, Black Friday, something like that. So you wait and then you buy it, and you buy it at a price much cheaper than maybe if you had bought it right away. So value investing is very similar, I think. And here we are trying to buy companies that we think are trading at a discount. If you look on this chart, you can see a dotted purple line, which is upward sloping. That represents to us the value of a company. We want to invest in companies that are growing their value over time. Business value tends to be much more smooth than stock price. So you can see the black line is stock price. It goes kind of all over the place. It can often disconnect with what the company is worth. And that actually gives us the opportunity to invest at a discount. So you can see that sometimes stock prices fall off. Sometimes it's due to, maybe a bad earnings report. Sometimes it's due to concerns around geopolitics. Sometimes some stocks just fall out of favor. And so essentially you get a gap. And so we think by exploiting that gap, we can improve our return profile over the longer term. So we're looking to make money essentially 2 ways. First, again, investing with growing companies. And then secondly, investing at a discount. And so we could eventually benefit from the convergence between price and value. Now, an example of how this kind of works in practice. So Meta, Netflix, Amazon, all companies that you probably know really well. We owned these companies back in 2022. We don't own these companies today. But it is interesting just to see, how divergent their stock prices has been. Meta down 64% in 2022 and then up 300% the next year and a half. I mean, do you really think that a company's value changed that much? No, it's really the stock price, which is moving all over the place. So a little bit about what happened in 2022. So why did these stock prices go down so much? Well, first, with higher inflation and higher interest rates, there was concern about the impact on technology companies. So we actually had a lot of good technology companies that sold off. Secondly, a lot of these companies benefited during the pandemic. We were at home, we couldn't go anywhere, we couldn't travel. So that means we spent more time online. That means we spent more time on social media. We bought things on Amazon. We subscribed to Netflix. So that activity was quite high and it really benefited these companies. But what happened in 2022 as the world was reopening again, a lot of this activity started to slow. And so people were concerned about the impact on these companies. And then lastly, these 3 companies, as well as other technology-related companies, they've really done so well over so many years, and they've made so much money that people never stop to think that, okay, actually, are these companies spending that efficiently? Do they have discipline when it comes to their expenses? And so in 2022, in kind of a more difficult market environment, there was more of a spotlight focused on the spending practices of these 3 companies. And so then what happened? Okay, Meta down 64%, Netflix down 58%, Amazon down 48%. And so these became attractive to us. We own them in our portfolio. We own a number of higher growth portfolios, higher growth stocks because they looked attractive. And then over the next year and a half, these 3 stocks meaningfully appreciated in price. So tech sentiment improved. A lot of the online activity went back to a more normal cadence. And then you saw a swathe of tech announcements, tech companies that were looking to operate more efficiently. They were going to lay off some employees. They were going to cut costs, et cetera. So the market liked that. Sentiment returned and the stock prices did well. So that's when we actually sold these three names in our portfolios. And so a lot of times when you think about investing in stocks, it's not just about, is it a good company? There are many good companies out there, but what price do you want to invest in stock? Do you want to invest in a stock when it's expensive, or do you want to invest in a stock when it's cheap? So again, this is an example of how a lot of higher growth companies we thought had value back in 2022. Right now, not so much. So where are we invested today? So this page shows a snapshot of our Harris US Value Equity Fund and how we are positioned in terms of sectors. So we are very underweight information technology. So we have about 4% in information technology, and that is relative to 32% in the index. We also are about double the weight of energy in our portfolio, so about 9% to energy versus 4% of the index. And then financials is where we have a pretty big difference. So we have about 38% of our portfolio in financials relative to 12% of the index. So it does seem like a lot, but we want to indicate that, financials are not just banks. So sure, we do have several banks in our portfolio, but there are also asset managers, insurance companies, consumer finance, credit card, payments. It's really an eclectic mix of undervalued securities, and that's why we feel as comfortable being as overweight as we are in the financial sector. And so a couple of examples of some of our holdings in our portfolio. So one example in our financials weighting is Fiserv. So I'm not sure if any of you or many of you have heard of Fiserv, but it is a financial technology company. It is classified as a financial. It has a pretty low weighting in the S&P 500, about 0.2% of the index. So maybe it's less known than some of the larger tech companies. But we think there's a really interesting investment case there. So Fiserv, based in Milwaukee in the US, it was actually founded in 1984. And Fiserv's initial legacy business was to provide technology solutions to other financial institutions. So that includes, for example, providing core accounting software, providing banks with the capability for online banking, for mobile banking, et cetera. A lot of smaller banks just don't have the capability to invent those technology solutions internally, and so they rely on companies like Fiserv to provide them with the technology so their clients can go on, do online banking, bill pay, things like that. And so Fiserv has historically had a very stable and defensive revenue stream because they're really providing mission-critical products on behalf of these banks. And then what happened in 2019 is that Fiserv also acquired First Data Corporation. So First Data Corporation has credit card processing capabilities. And so that means when you go to, say, a store and you buy something with your credit card, Fiserv can process a transaction on behalf of that merchant. And so you may notice that when you buy things using your credit card, even here in Singapore, you can see that your receipt will actually often have Fiserv on it. So essentially, we think that this company is benefiting from two sets of secular tailwinds. First, as banks further need to digitalize, as one of the top technology solution providers, Fiserv benefits. And secondly, it's really, the war on cash. As people spend less and less physical cash, they use credit cards more and more. Fiserv benefits as a credit card, as they process credit cards transactions. And so why do we think this is a value, actually? So over the past 5 years, since there was a business combination, since they acquired the credit card processing capabilities, Fiserv has had pretty good results, yet it's underperformed the S&P 500. And why has it underperformed? Well, a lot of investors have been quick to assume that smaller fintechs will be able to take market share away from big legacy incumbent technology providers like Fiserv. But we don't think that has to be the case. A company like Fiserv, which is quite large, they also have interesting innovative solutions, and we think they can also position themselves as a technology leader. So, for example, within the Fiserv business, they have a fintech called Clover, and Clover processes credit card transactions on behalf of small and medium businesses. So they provide point of sale solutions, for example, to small and medium businesses, and it's a very fast growing business within Fiserv. So this is an opportunity, again, a technology-related opportunity, but it's not as well known as, say, like NVIDIA or Microsoft, et cetera. And then one you might know a little better is Alphabet. So although we do not invest in most of the mega cap tech companies within the S&P 500, one we do like is Alphabet. Alphabet has been our top position for a while. And so why do we think there's a value in Alphabet? Well, first, there are a lot of different businesses within Alphabet. So Google, YouTube, Android, etc. And when we assign a value to each of those businesses and we add all those businesses together, the value of those businesses, we think, is much greater than the stock price. So most of us use Google search on a daily basis. So why is Google search such a massive business? Well, Google search essentially collects a toll on the growth of online commercial activity. So anytime you, say, book a vacation, you buy insurance, you buy clothes, you want to open a bank account, where do you start? Most of us start at Google search. And so the ads that are showing on Google are really being exposed to a large and diverse set of consumer spending. At the same time, global e-commerce is only about 20% penetrated. So there's still a huge runway to go in terms of Google search capabilities and their ability to grow over time. But there are also other businesses within Google, within Alphabet. So YouTube, for example, lots and lots of hours watched, viewers watching on average over 1 billion of hours of YouTube content on TVs daily. But still, there's a lot of monetization potential. The cloud business, for example. Cloud is an area where Alphabet is investing significantly. They can leverage their strong data science capabilities. Last year, the cloud business had a margin of about 4%. We think that there's the ability to move up to 20%, even closer to 30% over the long term. Right now, the margins are lower because of how much the company is investing. And then also the other bets portfolio. So there are other VC, venture capital type investments within Alphabet. So that includes, for example, Waymo, which is the autonomous driving subsidiary. So these businesses aren't really making any money today, but we think that there's value in the future. So again, when we look at something like Alphabet, we look at the sum of the parts. We think there's a lot of value there that sometimes might be missed by the market because investors may not understand all of the different components of the business and why we think they have value in the future. And now just to sum up, the Harris Associates U.S. Value Equity Fund, we know that there has been a lot of attention on AI. They have driven stocks to new highs. We do believe that those trends are very real. We think that they're very significant. But to a certain extent, we think that a lot of these stocks that have been driven by the AI buzz might look expensive today. So we want to reinforce the point that there are other companies that you can invest in. There are high-quality companies in the S&P 500. They're diversified by industry. They're diversified by sector, in healthcare, consumer staples, et cetera. These are good, large-cap generating businesses. We've been able to find a number of opportunities at a discount, especially as many, many stocks in the S&P 500 have lagged the big tech players. And so that's what we think we're getting, or what you're getting if you invest in the Harris Fund. Thank you.